One private citizen changing his voter registration address blew a $140 million hole in the state budget of New Jersey. This wasn't a corporate relocation. It wasn't some massive industrial shutdown. A single man filed the paperwork to move his primary residence to Florida in 2016, and the chief financial analyst for the New Jersey legislature, Frank Haynes, had to issue a formal warning to the state Senate. The departure of one individual critically compromised the entire state's income tax projections.
People operate under this baseline assumption that they actually understand the mechanics of extreme wealth. You think of it as purchasing power, the ability to buy real estate, acquire corporate equity, consume at a scale incomprehensible to a normal citizen.
Reality is far more severe.
Far more. At a certain scale, wealth ceases to be purchasing power. It becomes the ability to dictate terms to the state itself.
We are looking at a stack of financial filings, municipal bankruptcy records, market analyses, trying to map the specific architecture of this power by tracing the mechanics of David Tepper and his entity, Appaloosa Management. But to understand the threat model presented in these documents, you first have to recognize the billionaire speculator trap.
The dangerous, pervasive assumption that legendary hedge fund managers amass their fortunes by predicting the stock market better than anyone else. The public looks at these individuals and assumes they are merely superior analysts of corporate balance sheets, outsmarting other participants within the boundaries of a free market.
They do not predict the free market. They predict the exact moments when governments will be forced to abandon the free market to save themselves. They aren't analyzing the underlying health of a corporation. They are analyzing the political fragility of the system housing that corporation.
When you hear about a single entity artificially bankrupting an infrastructure project to protect his personal capital, and subsequently forcing a separate municipality to rebuild his private stadium using hundreds of millions in public funds, a fundamental classification problem emerges.
Are we analyzing a market participant or a sovereign state?
The official map of the 2009 financial crisis presents David Tepper as the ultimate contrarian value investor. In February and March of that year, the global economy was in a state of terminal panic.
Lehman Brothers was already gone.
Lehman was gone, and the market was actively preparing for the nationalization of the remaining financial institutions in the United States. While institutional capital fled to cash, Tepper deployed billions of dollars into the epicenter of the crisis. He bought shares of Bank of America for around $3. He bought Citigroup for roughly $1.
The mainstream financial press still frames this as a triumph of traditional market analysis. Appaloosa Management secured a $7 billion profit within the year, and Tepper personally took home around $4 billion. The narrative sold to you is that he saw the underlying worth of the banks when the rest of the globe was blinded by fear. He supposedly looked at the balance sheets, saw hidden value, and secured his position as the greatest macro investor of his generation.
Value investing requires an asset to have a floor.
Meaning a baseline intrinsic value you can actually count on if things go wrong.
Meaning the corporation will actually exist tomorrow. If a corporation is nationalized by the federal government, the equity floor isn't low, it is zero. The shares are wiped out completely. In early 2009, nationalization was not a fringe panic theory. It was the imminent, mathematically probable outcome.
The math of the corporate balance sheet is completely irrelevant if the corporate entity ceases to exist.
Buying Bank of America at $3 was not a valuation of its assets. It was a wager on political behavior.
This is where the structural logic of the trade breaks the official narrative wide open. Tepper recognized a fatal vulnerability in the state apparatus. He knew the United States Treasury could not allow global clearing systems to fail without triggering a total collapse of the modern economic order. You were essentially looking at a man betting that the casino owner will empty their own vault to extinguish a fire before the building burns down. He placed a binary bet on the inevitability of a government bailout.
He understood the Federal Reserve and the Treasury would be forced to step in to save the systemically important banks. By purchasing that distressed equity, he was effectively monetizing the state's fear. He structured a trade where the federal government socialized the risk through the taxpayer via the bailout programs, while he privatized the resulting multi-billion-dollar profit.
Capitalizing on a crisis isn't about predicting the free market. It is about pricing in the exact moment the state is forced to abandon it.
The structural evolution of his empire requires dissecting his corporate mechanics a decade later. In 2019, Tepper initiated the process of returning external capital to his investors. He shrank Appaloosa management from a massive institutional hedge fund down to a $15 to $23 billion family office.
The standard narrative portrays this as a billionaire stepping back from the grueling pressure of institutional management to quietly handle his own money.
Map that 2019 transition to his physical operations in the real world. Think about your own local taxes for a second. Imagine your city is partnered on an $800 million megastructure. That is what happened with the Carolina Panthers practice facility in Rock Hill, South Carolina. Tepper began construction in 2020. A dispute arose over $225 million in municipal bonds that the city of Rock Hill was supposed to issue for the project's infrastructure.
When the dispute stalled the project in 2022, the specific development company overseeing the build filed for Chapter 11 bankruptcy. The physical construction stopped cold. The contractors were left unpaid. The city was left with an abandoned, half-built skeleton of a facility.
The media reported this as a standard real estate failure, a casualty of municipal disagreements and rising supply chain costs.
Refuse the narrative of a standard failure. The math is utterly absurd. A man sitting on over $20 billion in an unconstrained family office does not accidentally run out of cash to finish an $800 million building. The money to complete the Rock Hill facility was always there, liquid, and available. The bankruptcy was not a financial inevitability. It was an active, tactical choice.
Converting Appaloosa to a family office achieved absolute autocracy. He eliminated external limited partners. He removed the institutional pressure of quarterly reporting. He stripped away the oversight of the Securities and Exchange Commission that applies to traditional funds.
Then, he applied this exact same architecture of autocracy to the physical world in Rock Hill. He did not build the facility using the core capital of Appaloosa. He did not use the assets of his sports holding company, Tepper Sports and Entertainment. He created a completely isolated shell company, GT Real Estate Holdings.
When the municipality of Rock Hill did not bend to his terms regarding the bond issuance, he intentionally killed the shell company. He stranded the city and the contractors by forcing GT Real Estate into bankruptcy court in Delaware. This maneuver legally walled off his $20 billion fortune from any liability associated with the ruined project.
Creating that shell company was basically like a lizard dropping its tail. The second the city of Rock Hill grabbed onto the project and refused to issue the bonds on his terms, he just detached the tail, let it die in a Delaware bankruptcy court, and his $20 billion fortune scurried away completely unharmed.
The local authorities attempted to pierce that wall. The York County Sheriff and the South Carolina Law Enforcement Division, known as SLED, opened a formal criminal probe. They were investigating the potential misuse of $21 million of public funds related to the road infrastructure for the failed project.
The state threatened the one thing his corporate shields could not protect: his personal liberty and reputation via criminal charges.
He deployed capital to extinguish the threat. Through the bankruptcy proceedings, he initiated a wave of civil settlements. He directed $20 million to the city of Rock Hill. He paid $21 million to York County. He distributed over $60 million to the stranded contractors. In total, he utilized over $100 million in cash to flood the zone and satisfy the civil grievances.
In September 2024, the South Carolina Attorney General's office released an official letter formally closing the SLED investigation. They stated they found no criminal intent and noted that all civil disputes had been resolved.
He bought his way out of a state-level criminal probe by writing checks that represented a fraction of a percent of his net worth. His core capital remained entirely shielded.
Corporate structure is not a tax vehicle. It is an isolation chamber for risk, deployed as a weapon against the municipality.
Examine his recent consolidation of power in June 2024. The Charlotte City Council voted 7-3 to approve a massive renovation project for the Bank of America Stadium, which Tepper's organization manages. The mainstream framing, heavily promoted by local politicians and media, presents this as a crucial public-private partnership. The narrative claims this deal is necessary to drive local economic development and retain the Carolina Panthers NFL franchise and the Charlotte FC soccer team in the city for the next 20 years.
The word partnership implies a shared assumption of burden and reward. The actual terms of the agreement expose a severe contradiction. The city of Charlotte is draining $650 million from funds generated by consumer taxes on tourism and hospitality to pay for the stadium upgrade. Tepper is contributing just $150 million up front.
The public assumes over 80% of the primary financial cost. The private owner, however, captures 100% of the capitalized asset value. The stadium's modernization directly inflates the valuation of his privately held sports franchises.
He utilizes capital mobility as a hostage situation. Tepper is fully aware that local governments are economically and culturally dependent on the physical presence of a National Football League monopoly. He forces municipalities into a brutal binary choice: fund the physical infrastructure of his monopoly using public tax dollars, or watch the asset leave the jurisdiction entirely.
Connect this local extraction directly to his global macro moves on the stock market in the exact same time frame. Look at the mandatory SEC 13F filings for Appaloosa management in the first quarter of 2026. Tepper aggressively dumped 32.6% of his shares in the Chinese e-commerce giant Alibaba. He liquidated a massive position in an environment of escalating geopolitical risk and potential tariffs.
He immediately pivoted that billions in liquidity into critical U.S. infrastructure, specifically increasing his stake in Micron Technology by 11% and doubling his position in Amazon to capture the artificial intelligence boom.
He ruthlessly and instantly de-risks his private financial portfolio on Wall Street at the first sign of international volatility. Simultaneously, he forces the taxpayers of North Carolina to absorb the physical and financial risk of his real estate empire.
He protects his own capital with microsecond precision while locking a municipality into a two-decade, $650 million liability.
The sources reveal a profound psychological paradox that cannot be fully reconciled. The analytical model of David Tepper portrays a cold, mechanical genius. This is an operator who flawlessly navigated the 2009 collapse of the global financial system. He constructs impenetrable corporate shields that defeat municipal governments. He executes multi-billion-dollar algorithmic trades in the AI sector with total discipline.
Yet in the physical, operational world, his behavior is completely volatile.
The incidents of public loss of control are documented and frequent. He cycles through head coaches for his sports franchises at an irrational pace, paying out massive buyouts, demonstrating an inability to delegate or maintain an organizational culture.
He personally marched into a restaurant in Charlotte, confronting the staff and demanding the removal of a sign that mocked his management decisions. Most severely, during a game on New Year's Eve, he threw a drink from his VIP suite directly onto a fan of the opposing Jacksonville Jaguars. This act earned him a $300,000 fine from the NFL and generated massive reputational damage.
The guy who executes microsecond algorithmic trades with ice-cold discipline is the same guy chucking a cocktail at a Jaguars fan from a luxury suite because he lost his temper.
This represents an analytical failure in the model. The strategy of weaponizing capital works perfectly against abstract financial markets and rigid legal systems. It shatters when applied to human beings and organizational culture. The sources document a man who possesses the leverage to dictate economic reality to the Federal Reserve and entire state legislatures, but who cannot maintain basic emotional regulation within his own operational ecosystem.
The sources leave us with a load-bearing contradiction. We do not know if this extreme emotional volatility is the fatal flaw that will eventually collapse his sports and real estate empire from the inside out, poisoning his ability to attract talent and maintain political allies.
Or, conversely, we are witnessing the harmless, unchecked collateral damage of absolute power, the reality that a $20 billion autocrat simply no longer faces consequences for physical outbursts. The data does not provide a resolution to this gap.
If capital mobility is the ultimate weapon, what happens when these sovereign individuals decide the physical United States is no longer a favorable jurisdiction at all?
Looking at the $650 million stadium subsidy in Charlotte, the engineered bankruptcy of the Rock Hill facility, and the $140 million tax shock to New Jersey as a story about a billionaire extracting wealth from the public is the wrong framework entirely.
He isn't extracting wealth. He is remapping the boundaries of jurisdiction. In his operational model, the state exists to provide the upfront capital, to absorb the systemic risk, and to handle the legal and social fallout of his ventures. He retains total autocracy over the profits and the direction of the assets.
You are not watching a man participate in the American economy. You are watching a man who has realized the economy is simply a mechanism designed to convert public resources into private sovereignty.